The market is always buzzing with new stock ideas, but which ones are actually worth your attention? Today, we're cutting through the noise to spotlight some of the most talked about companies: Novo-Nordisk, Whirlpool, Spotify, and more. I'll break down what's driving each stock, highlight key risks and rewards, and share what analysts are saying. This isn't a buy or sell list. Think of it as your launchpad for deeper research. Ultimately, your investment decisions are yours alone, so use this as a framework to start your own due diligence. Let's dive into our first stock. First up, Novo-Nordisk, ticker NVO, a pharmaceutical powerhouse behind Ozempic and Wegovy, two drugs that have transformed the weight loss market and become household names almost overnight. These medications have not only changed the way doctors treat obesity and diabetes, but have also sparked a cultural conversation about health and wellness. Their stock has soared, fueled by surging demand and global expansion, making Novo-Nordisk Europe's most valuable company at times. Investors have taken notice as the company's market cap has reached new heights, reflecting both optimism and excitement about its future prospects. The obesity and diabetes treatment market is massive and still growing, with millions of new patients each year. Novo's first-mover advantage is significant, giving it a strong foothold in a sector that's expected to expand for decades as global health trends evolve. They're also researching new uses for their drugs, including potential applications in heart disease and other metabolic conditions, which could unlock even more growth and diversify their revenue streams. But competition is heating up. Eli Lilly's Zepbound and Mounjaro are strong rivals, and more companies are entering the space, eager to capture a share of this lucrative market. This could mean price wars, increased marketing costs, and potentially slower growth ahead as the battle for market share intensifies. Analysts are mostly bullish, citing Novo's leadership, innovative pipeline, and the expanding market, but many warn the stock is expensive and may be pricing in a lot of future success already. The price-to-earnings ratio is high, so a lot of future growth is already baked in, leaving less room for error if things don't go as planned. Any stumble, like production issues, regulatory setbacks, or a competitor's breakthrough, could trigger a sharp pullback and rattle investor confidence. If you believe in the long-term potential of weight loss drugs and Novo's ability to stay ahead of the curve, paying a premium might make sense for your portfolio. But if you're a value investor, you may want to wait for a better entry point, especially given the current lofty valuation. The current price leaves little margin for error, so caution is warranted for those seeking a wider safety net. Novo-Nordisk is a phenomenal business, but patience could pay off if you're looking for a safer entry or waiting for a market dip. Watch for pullbacks or market corrections as potential opportunities to buy into this leader at a more attractive price. For now, it's a high-quality company with high expectations, and the story is far from over as the healthcare landscape continues to evolve. Next, xelixis, ticker XELE, a biotech focused on cancer treatments. Their main product, Cabometyx, drives most of their revenue, but the real story is their pipeline of experimental drugs. The stock is volatile, swinging on clinical trial results. Success can send shares soaring, failure can be brutal. Analysts are split. Some see big upside if new drugs succeed. Others worry about competition and reliance on Cabometyx. The risk is high. Future growth depends on scientific breakthroughs, not just sales. If you're comfortable with volatility and want exposure to potential biotech wins, xelixis could be interesting. But if you prefer steady earnings and less drama, this might not be for you. Investing here is a bet on R&D and the unpredictable world of drug development. Do your homework on their pipeline before jumping in. The upside is real, but so is the risk of disappointment. For aggressive investors, it's a speculative play. For the risk-averse, it's probably a pass. Know your risk tolerance before considering XELE. This is classic biotech, high risk, high reward. Now let's talk about Whirlpool, ticker WHR, a true household name in the world of appliances, with a legacy that stretches back over a century. From washing machines to refrigerators, Whirlpool's products are found in millions of homes around the globe, making daily life a little easier for families everywhere. They're a global leader with a powerful portfolio of brands, including KitchenAid and Maytag, but their business is highly cyclical, closely tied to the ups and downs of the housing market and shifts in consumer spending habits. When people buy new homes or renovate, demand for appliances rises, but when the economy slows, so does Whirlpool's growth. Recently, Whirlpool has faced some serious headwinds. Inflation has driven up the cost of materials and manufacturing, while high interest rates have cooled the housing market, leading to fewer home sales and renovations. This has put real pressure on demand for big-ticket appliances. As a result, profits have taken a hit, and the stock now trades at a low valuation compared to its historical averages. Investors are watching closely to see if the company can turn things around. Value investors see opportunity here. If you believe these challenges are temporary, buying now could pay off handsomely when the economic cycle eventually turns and demand rebounds. In the meantime, the company pays a solid dividend, offering investors some income while they wait for a potential recovery. That's a nice cushion in uncertain times. But there's a bear case to consider: fierce competition from global giants like Samsung and LG, plus the risk that economic weakness could drag on longer than expected, keeping demand for appliances low. Whirlpool could end up being a value trap if earnings don't recover, and the stock remains stuck at these depressed levels. This is a classic contrarian play, buying a strong, well-known brand at a low point in the business cycle, hoping for a turnaround. Patience is key here. Recovery may take time, and investors need to be prepared for a potentially bumpy ride. If you're a long-term investor with a strong stomach for volatility and a belief in Whirlpool's brands, it could be worth a closer look. But if you're looking for stability and steady growth, you might want to wait until the economic picture is clearer. Ultimately, the risk and reward here is all about timing the cycle and understanding where we are in the broader economy. So, know what you're buying and why. Do your homework, and make sure Whirlpool fits your investment goals and risk tolerance. Whirlpool is cheap, but for a reason. Make sure you're comfortable with the risks before jumping in. Switching gears, let's address Webull, the commission-free trading platform. Many use it, but can you invest in it? Not yet. Webull is still private. They plan to go public via a SPAC merger, but the deal is still pending. If the merger happens, Webull will trade publicly, and you'll need to evaluate it like any new listing. The bull case: strong brand, rapid user growth, and potential to monetize its active base. The bear case: fierce competition, thin margins, and the challenge of turning a profit. Just look at Robinhood's struggles. If Webull does go public, focus on its financials, user growth, and path to profitability. For now, keep it on your watch list. The brokerage space is crowded and cutthroat. Disruption doesn't always mean profits. Wait for the SPACs deal to close before making any moves. Exciting company, but not yet investable. Stay tuned for updates. Next up, Spotify, ticker SPOT, the global leader in music streaming. They've revolutionized how we listen to music and are pushing hard into podcasts. User growth is strong, with millions joining both free and premium tiers. More premium subscribers mean more recurring revenue, but profitability remains elusive. High royalty payments to music labels eat into margins, making it tough to scale profits. Bulls believe Spotify will eventually leverage its scale, negotiate better deals, and grow higher-margin businesses like podcasting and audiobooks. Bears worry the low-margin model is permanent, and competition from Apple, Amazon, and YouTube is fierce. Spotify's future hinges on turning market leadership into sustainable profits. If you believe in management's vision and new revenue streams, it's a growth play. If you're skeptical about the economics of streaming, you might want to pass. The product is great, but the business model is tough. Spotify is a bet on innovation and execution. Watch for signs of improving margins. It's a growth stock with real challenges. Now for something speculative. TMC, the metals company, ticker TMC. They aim to mine critical battery metals from the deep ocean, betting on the green energy transition. The promise: a new, potentially less destructive source of nickel, cobalt, copper, and manganese. But the risks are huge. Regulatory hurdles, environmental backlash, and unproven technology. TMC needs international approval to start mining, and opposition from environmental groups is fierce. The company is pre-revenue and burning cash, with everything riding on getting a license and proving their process works. The stock is highly volatile, moving on news and speculation. If they succeed, the upside could be massive, but failure means the company could be worth nothing. This is a venture capital style bet, not a traditional investment. Only invest what you can afford to lose. For most, it's too risky. If you love moonshots, tread carefully. High risk, high potential reward, but no guarantees. Let's wrap up with two industrial giants, Carrier Global, CAR, and United Parcel Service, UPS. Both companies are household names, but they operate in very different corners of the industrial world, each with its own unique strengths and challenges. Carrier is a global leader in HVAC, refrigeration, and fire safety, benefiting from powerful trends in energy efficiency, climate adaptation, and the growing demand for sustainable infrastructure. Their strong brand reputation and massive installed base provide steady, recurring revenue. Analysts see long-term growth potential as buildings worldwide upgrade for sustainability and stricter environmental standards. UPS, on the other hand, is a logistics powerhouse, absolutely essential to global commerce and the backbone of e-commerce delivery networks. Recently, UPS has faced headwinds. Post-pandemic shipping volumes are down, labor costs are up, and competition from Amazon and other delivery services is more intense than ever. The stock looks cheap compared to historical averages, but the risks are real. Margin pressure and market share threats could linger for some time, making the near-term outlook uncertain. Carrier is a steady grower tied to secular trends in sustainability and infrastructure. UPS is a cyclical value play with near-term challenges, but long-term potential if it can adapt. Both companies pay attractive dividends, rewarding shareholders with consistent income, but they fit very different investor profiles. Carrier suits those seeking stable, long-term growth and exposure to green building trends. UPS is for contrarians betting on a rebound in shipping volumes and efficiency gains as the global economy evolves. Both are industry leaders, but face very different risks and opportunities in the years ahead. Know your portfolio needs and risk appetite before choosing between them. Carrier rides the wave of sustainability and infrastructure upgrades. UPS rides the ups and downs of the global economy and e-commerce. Each has upside, but for very different reasons. Carrier for its steady green growth, UPS for its potential turnaround. Match your pick to your risk tolerance, investment goals, and outlook for the future. That's a quick tour of 7 very different stocks, each with unique stories and risks. There's no one-size-fits-all answer. What's right for you depends on your goals and risk tolerance. Use this as a starting point, but always dig deeper into the numbers and competitive landscape. Investing is about diligence and patience, not hot tips. Share your thoughts in the comments. Are you buying, selling, or watching any of these? If you found this helpful, hit subscribe and stay tuned for more stock analysis. Thanks for watching. See you next time.